Alrighty. So today I have another video for you guys on the wheel strategy, but this time it's for small accounts because I know that not many of you guys have a large account. So if you have a trading account of roughly $10,000 to $25,000, then this is for you, right? So you can still do the wheel strategy even though you have a limited number of capital, right? But if you have anything lower than $10,000, then it's going to be a little bit difficult to do the wheel strategy. So I would say you need roughly around $10,000 to $25,000 to be able to get started in the wheel strategy. So as always, I'm going to just have a very quick recap on what the wheel strategy is. So basically, you just start off by selling a cash secured put. So a cash secured put, basically what you want to do, the goal is to get the premium. And if let's say the market actually closes below your cash secured put, you're going to get a sign on the 100 shares. So when you have the 100 shares, what you want to do is you're going to sell the covered call. Now you can sell the covered call at the place where you sold the cash secured put, or you can sell it above the cash secured put place where you're assigned the 100 shares, so you can also get the intrinsic value gain on the 100 shares. And then once let's say the market goes above your cover call, you're going to have your shares called away, and then you're going to have a position back to zero, and then you keep doing this. So for the wheel strategy for small accounts, there are two methods for stock selection, and this is something that I've already covered previously in another video. So that one I get into more detail where I go into the details of these two methods. So if you haven't watched the video, you can go ahead and watch that. I'll put the link at the top right hand corner. But just for a very quick overview, basically there are two methods when people do the wheel strategy, right? So the first method is to focus purely on the extrinsic value gains. That means all you're concerned about is getting as much premium from your cash secured put and your covered calls. So the stock selection for this is pretty straightforward and simple, and that is to look for stocks with very high implied volatility, right? Because the higher the implied volatility, the more premiums you're going to get, and that's what a lot of people want to do when they're doing the wheel strategy. But for me personally, I do not go with method 1. I go more for method 2 because I want to be focused more on intrinsic value. That means I want to ensure that the stocks that I choose will have a very good chance to go up in the long term, right? That it will always go up in the long term, as opposed to stocks which are mainly for high IV. You know, they could be like your AMCs, right? They will go like all the way up, then all of a sudden they will just dwindle down there, and there's no prospects of whether it will go back up to the highs, right? So if you were to get into a cash secured put somewhere here and then you got a sign, you're not sure whether the market will eventually go up, right? It's a question mark because a lot of these companies, they are not profitable yet. So if they're not profitable, we're not sure whether is the market going to, continue buying this stock to push it up. At the moment right now, it's still uncertain. But whereas if I go for stocks which have strong fundamentals, then there is a higher chance that the market will always make higher highs and even survive past crashes, right? So I'm more focused on this method where it's more for intrinsic value and it has moderately high extrinsic value gains. So basically I also go for stocks that are tech stocks. So these tech stocks generally have higher implied volatility compared to other types of stocks like consumer stocks and all that, right? So that is for method 2. So basically for this, I look for stocks with moderately high IV plus strong fundamentals and history of surviving crashes. So there is much more work to do compared to method 1, because method 1, all you have to do is just use any stock scanner, look for high implied volatility, and you just decide which stocks you want to go for. But for method 2, you have to really dive deep into the stock itself. You want to know that the stock has actually good fundamentals, and by that I mean there's increasing revenue, it's increasing profits, they have strong free cash flow, the assets are more than the liabilities, right? And also it has the history of surviving crashes, right? Has it survived, the 2000.com crash, survived 2008 crash, the pandemic crash, and everything has gone higher since. So this is the method I go more for. In fact, it's the only method I use for my investing, for my trading as well, because I want to have the comfort of knowing that there's a good chance that the market will always go up, especially right now when the market is crashing. If you are caught in certain stocks where you do the wheel strategy, there's high IV, and you're caught like maybe AMC, maybe you got it down here. Right now, you're not sure whether it's going to go back up, right? So it's very uncertain. So I prefer the safety net that the market has a better chance of going up in the long term. That's why I go more for method 2. Now, when doing the wheel strategy, diversification is very important, right? Because the last thing you want to do is put your funds into just one position and the market tanks and you run out of funds to continue the wheel strategy. Because if your funds are very limited, you may have very little options in terms of stocks, right? Your stock selection will be much lesser. So let's say, for example, if you only have $10,000 to play with, let's say you only $10,000 for the wheel strategy, and you found a stock, say maybe Starbucks, right? Starbucks maybe is around $80. So what that means is that you can pretty much only have one position on, right? Because one position, if you sell a cash put on it and you get exercised on it, you're going to get long 100 shares, and this $80 is going to be basically $8,000 in capital. And with a $10,000 capital, you only can have one position, right? But what happens if the market continues to crash after you entered into this position? Then you basically be stuck, right? You can only sit on your hands and you cannot get into more positions, and you've stopped your ability to get income, right? Which is what the wheel strategy really is about, right? The wheel strategy is about just generating income over and over again over time, right? You can always be selling cash account put and covered call, but if you are stuck in a position where your entry price is so high, let's say your entry price is over here, this is where you entered your positions, right? Your entry price, and then right now the market has crashed all the way down here. Right, at this point of time, you cannot sell any covered call at this price because it's just too far away. There's not enough premiums. And I've spoken to a number of people have emailed me asking me what can they do, whether they can sell a covered call below the entry price. Now, while that is an option, it is always a risk, because if there's a chance, let's say for example, there's some news that really moves the market, right? It could be news that, maybe the war stops or the Fed stops the quantitative tightening. The market may take it very positively. It may really rally up, and at this point of time you can't really roll your cover call up, so you become stuck in a position where you have this loss, right? You're stuck in this loss from where you entered and where your shares get caught away. So while you could do the cover call below your entry price, is a little bit risky, and generally I tend to stay away from that, but I do know that some people actually do that, right? So when it comes to wheel strategy for the small accounts, diversification is very important, right? Because you want to always ensure you keep getting an income regardless where the market goes, right? If you get stuck in one position, then who knows when the market is going to come back. If the market is going to come back maybe in the next 2 to 3 years, it means to say you can't get any income for 2 to 3 years. So that is why before you get into the wheel strategy, you want to plan this very well in advance. So when it comes to diversification, there are two types, right? You have horizontal diversification, and because there is limited funds in your small account, I would say that you want to go for ideally 3 to 5 low to no correlation stock or ETFs with one position each, right? Again, you have very limited funds, so you want no correlation, low to no correlation, because if the stock of all the stocks that you chose are all correlated, well, if one was to crash, then all is going to crash. So it's as though you just have one stock position, right? So it's important to have to understand the stocks that you're in, that they are not really that correlated, right? The other diversification is vertical diversification. That is to have just one core stock or ETF with multiple entry levels each. Alright, so this is the horizontal diversification. So basically, you have 3 to 5 low to no correlation stocks or ETFs with one position each. And let's say you have $20,000 in account. So maybe this is what you might want to do, right? You have 4 stocks with allocation of around $5,000 each in 4 different sectors, right? Hopefully they are all uncorrelated or not as correlated as possible, right? So maybe you have one in the tech sector, you allocate probably $5,000. You want in the healthcare, 5,500. You have one in the consumer, right, 4,500, and another one in the financial sector, $5,000. And the thing is that although they may have not that much correlation, right, let's say you choose 4 stocks that are not that highly correlated, but in the event that the market crashes, when the market crashes, everything will sell off. So that is why it's also important to not enter all these 4 positions at one go, right? You may want to enter it, stagger it by timing. So maybe, for example, when the market has really tanked, you see that the broad-based index, everything is dropping. You might want to enter into the technology stock first, right? Enter into technology stock. Now, all these stocks have probably crashed as well. It has gone lower, right? But you do not want to enter them as well. So maybe you want to wait maybe a week later. If the market still continues to drop, then maybe you enter into the healthcare, and then maybe another few days go by, the market drops even further, you get into the consumer and then the financials as well. So this way, you do not get trapped in the position whereby, you know, if you were to enter it all on the same day, all roughly at the same time, if the market is going to crash tomorrow or the day after, well, all these stocks are all going to go down. Right, if they're all going to go down, you're going to be trapped in all this stock again. So it's the same thing. You may get trapped in all these 4 positions. Right, let's say you got one position here, another position here, another position here, another position here. This is cash secured put, by the way. You sell the 4 cash secured puts, all on the 4 different stocks, and then the market continues to crash, right? All of them crash. As we know that right now, as the market is crashing, everything goes down. Nothing is really going up. Even bonds are crashing. So when this happens, you're gonna get into a real world of pain, right? As a lot of people are experiencing right now. And you may even get into a position whereby all 4 of them, you can't even sell the covered call, right? So rather than do this, what you want to do, let me just remove all this drawing. What you want to do instead is enter this first. If the market crash, right, then you enter the other stocks, right? Enter this one, then maybe this one, maybe it starts to drop even further, so this will drop along with it. Then you start to sell another cash secured put on another stock again. So maybe this time the market suddenly rallies, right? It goes up, and this one goes up as well. This one goes up. So at this point of time, you cannot sell covered call on this because it's too far away. But guess what? You can sell covered call on this, right? So you imagine if you already get assigned 100 shares, you can get a covered call exactly at the entry price. So this way you get the premium for both the cash secured put and the covered call. But for this, guess what? Your cash secured put might just expire worthless. Or maybe you're lucky enough, you get assigned already before the market rallies, and then you can sell a covered call above. So this way you get both the premiums on the cash secured put and the covered call. At the same time, you get the capital gains on the stock, right? The intrinsic value from here to here. So this way, this stock may be stuck, but guess what? You have this stock to make some income. This stock makes some income as well. So this is how you want to protect yourself in the event where the market crashes. Now, of course, the downside to that is that if the moment you enter the first one, if the market suddenly rallies, then you may not have a chance to enter this 2, 3, 4 other stocks, right? So you would just have one position making money, which is not as much as compared to if you have 4 positions on, but there's always a trade-off. So you want to think when the market, which is more painful for you, missing out on profits or getting into all 4 positions and then being caught and not being able to sell an income. Right, so this is something that only you can answer. By the way, if this video has been helpful to you so far, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. Okay, back to the video. Alright, so what if you have a smaller account? If you have a smaller account, then your choices are even more limited. So maybe you want to go for 3 stocks instead, right? Allocate roughly $3,300 each. So maybe you have technology, healthcare, and consumer. So as you can see, the smaller your account size, the more limited you are in terms of stock selection and the stock price as well. And generally, from what I notice is that the smaller price stocks, the lower price stocks, tend to be stocks that aren't as good fundamentals as the higher price stocks, unless they really had a stock split, right? Because generally, if you think about it, the stocks that have been around since 2000 and have survived all the crashes, the prices would have only have gone up, right? That means people have bought more into it. That's why the prices are slightly more expensive. So if you have a smaller account, your choices are more limited, so you have to be much more selective. Right now, next would be vertical diversification. So vertical diversification is, instead of going for many stocks, you just choose one core stock or ETF with multiple entry levels, right? So I would generally always prefer ETFs as well, because it, like I said, it is diversified in a sense already compared to one stock. So let's say, for example, you have $20,000 account. So there are 2 ways you can stagger the different levels. You can stagger them by either dollar or percentage. So dollar is basically just, let's say for example, you have $20,000, you just go by different levels, right? Let's say you split them into 5 levels. The first entry levels will be at $50. The next level 45, 40, 35, 30. So this in total will be $20,000. So in this case, actually, you're not really that afraid of a crash, because if the market really crashes through your levels, that is how you actually make money, because the more levels that you get filled, or rather you get assigned on the 100 shares, the more you'll be able to make, because you'll be able to sell, your cover calls and your cash account put at all times, right? So if the market was to just go back and forth like this all the time, guess what? You'll be able to sell your cover calls, you sell your cash account put all the time, right? So this is by dollar interval. Now, what about percentage interval? The other way is by percentage. So basically for percentage, I like to just identify the percentage based on the high of the stock's price. So let's say, for example, the high is $70, the current price is $50, then I might say, all right, my first entry level for the cash account put will be at $45.50, which is 65% of the stock, right, from the highs, right? So that means the market has really dropped 35%. And at this point, right, I may want to plan a drop of all the way to 45%. I may think that maybe 45% would be one of the lowest point where the stock could go to. So this way, I would have 5% interval each. As you can see, it's 5% interval difference from each level. So this way, I plan the percentage and then the cash account put levels respectively. So of course, we do not enter all at the same time. We want to do this each time depending on where the stock moves, right? So for example, at the moment right now, if the stock's $50, I'll only sell the cash account put for $45. Now, if the stock goes past this first cash account put level, then I will start to sell this $42, right? If it goes further down to this zone between level 2 and level 3, then I will sell this $38.50, and it drops further, I will sell this, and so on and so forth. So basically you get it. So the whole idea of vertical diversification is that your mindset is much more towards preparing yourself for any worst case scenario, because you never know what's going to happen, right? If the stock has bad earnings or good earnings, and then the market interprets it as a negative thing for some reason, right, the market could just gap down. If you had only one entry, if the market was to gap down, you're going to be caught, right? Like I mentioned earlier. But if you have many levels, you're not going to be afraid of that, because you have already prepared yourself for a big drop, right? As you can see, from the first level to your last level, that is a 20% drop, right? A 20% drop is pretty big for a stock or even an ETF, right? So when you do it this way, you're always preparing yourself for getting an income. So if the market drops, you're selling cash account put, selling the cover call all the time, right? Now, of course, again, like I said, if the market was to just rally after it goes up, then you're going to miss out on selling level 2, 3, 4, 5. But right now, in the current situation, where we are in a bear market, the market is crashing, vertical diversification would be my choice in terms of doing the wheel strategy. So here is an example on the XLF. So XLF is the ETF, the financial ETF, which is actually a very low price stock, right? It's a very low price ETF, and it's very good if you have a small account. So let's say, for example, you have $20,000. Right now, you can see the market is roughly around $31.18. So you could plan this all the way to how far you want it to go. So I always want to plan for the worst case scenario, because I don't want to get, be in a situation whereby the market really crashes, then I go, damn it, I should have, waited a little bit longer before I sell the cash account put. Because the thing is that we never really know. We don't know how far the market can go down further. We don't know when it's going to snap back up. So all I know is that I just want to prepare for in case there is a possibility it goes down. And my aim is to always get an income. So this is the pandemic low, right? 2020, there was the crash. So to me, I may think that, all right, this might be a possible low that the market may reach if it continues to go down, continues to crash. So I want to prepare for this event. So I want to prepare levels all the way down to this level. So in this case, I might want $2 difference in between the levels. So you can see I can prepare starting from $30 and then have $2 interval. Every $2 interval, I will have a cash account put ready to get activated. And then the lowest price will be $16, which is just below the low of the pandemic. And then the lowest I could get actually two cash secured put, because if you were to add all this up, the total capital would be around 20,000, would be just about $20,000. So you know that you have everything laid out, all planned out. So as we know, as the market goes low, there's always a chance for it to snap back up. So as you can see, I will be selling cash secured put on each of these levels, and let's say it does snap back from here. Guess what? I'm able to earn the intrinsic value gains, the capital gains, if I get assigned on the 100 shares for each of these levels, right, as it goes up. So this way, I always ensure, right, I prepare myself that I'm always getting some sort of income regardless of where the market goes, right? So I know that I'm already prepared. So this way, all I do is I just execute it if the market goes up. Now, what happens, all right, what happens if the market just goes up from here, right? Let's say you sold the $30 cash secured put and the market shoots up, right? The market shoots up, let's say, to $36. What do we do now? Well, you can recalibrate your whole cash secured put levels, right? So maybe if it goes up, wait for it to come down, then maybe at this point you could say the new level will start at $32. Then again, you want to start to reevaluate the dollar interval. Maybe then you might want to do $3 interval if you still feel that maybe you say $16 is going to be low I want to have. So you take $32 as your first entry and $16 as your last entry. Then you want to calculate your capital to see how many dollar intervals you have, right? Maybe it's a $3 interval to eventually match the lowest at $16 or thereabout. And then basically this is how you do it, right, for the vertical diversification. Now, if you have a $10,000 account, it's going to be a little bit more difficult to get more levels, as you can see. So you might only be able to do 4 levels for $10,000, but you still be able to plan yourself, you know, to the lowest level, $18, right? So this is just one alternative, right? Maybe you're more optimistic. If you're more optimistic, you might say that, hey, I think $26 could be, you know, a very good price to get in. That will be the lowest. So you may not even want these 2 levels. So in this case, it means that you still have more funds to do additional 2 levels, right? You may want to put 2 more levels in between here, right? So you have total 4 levels, and maybe this will be just nice, $10,000. Use up the $10,000 capital in your account. So basically, you can see it's very versatile in how you can arrange the levels for the wheel strategy. All right, guys, so some takeaways. So with small accounts, you have a very limited choice of stocks to choose from. That's why you want to be very selective with the stocks you choose, and that is why diversification is very important to avoid getting caught in a position when the market tanks and you have no more funds to continue the wheel strategy. So this is a very common problem right now. A lot of people have actually mentioned that they are caught in their position where their cash secured put is very deep in the money. What can they do? Well, in that case, there's pretty much not much you can do, rather than, you know, all you can do is just get yourself assigned, get 100 shares, and just hope that the market goes back up if you're out of funds. But if you still have the funds, then this is where you want to start to prepare, right? So there are 2 diversification methods. You have horizontal diversification, which is 3 to 5 stock or ETFs with 1 position each, and then you have vertical diversification, is 1 core stock ETF with multiple entry levels, and then you have the diversification for vertical in terms of dollar intervals, and you have percentage intervals. So the most important thing is to always plan for the worst case scenario to ensure you always have funds to generate an income for the wheel strategy. So remember, wheel strategy is an income generating strategy that you are always selling something, selling a cash secured put or a cover call, so that you're always getting income. So the key for it to be successful in the long term is for you to plan the worst case scenario and to diversify according to either the horizontal method or the vertical method. Alright guys, so that's it for this video. I hope it has been very helpful for you, and if it has, I'd appreciate if you give me a thumbs up and also subscribe to my channel as well. And as always, thank you for watching. I appreciate your time, and may the options favor you.